additional income for ETF, but the person who is borrowing shares from you may not return those shares to you. That is a counterparty risk that the ETF face. Now, comparison between ETFs and mutual funds. Management style of ETFs is mostly passive. MF, mutual funds, it's mostly active. Transparency is full because ETF disclose their units every day. Mutual funds is limited. They generally disclose it quarterly and they only highlight top 10 holdings. Cash drag is low. Cash drag is high in mutual funds because mutual funds have to maintain higher cash for redemption purposes. Embedded fees are low. Embedded fees are high. Advisory compensation is commission when you buy and sell ETFs. It is fees and load, and it has a large trailing component. Distribution is like stocks, so they are bought and sold on an exchange. Mutual fund, it is primary market, so you directly buy from the source, that is the mutual fund company. Tradability, margin and short sold, they can be margin, they can be used as a margin to borrow money. They can be short sold. You can put limit and stop loss trades. Mutual funds, short selling is not allowed. You can use them for margin, but limit and stop loss trades are not relevant because it's a primary market transaction. Minimum investment in single units, it's $500 or maybe lower than that also if it is systematic investment. Now, you can have pre-authorized contributions or systematic withdrawal plans. Easier on mutual funds, they are way harder on ETFs. Dividend reinvestments, only few dividends are reinvested. Few ETFs allow dividend reinvesting. Most of them pay dividends as cash. Mutual funds, they generally allow dividend reinvesting. Liquidity, it is based on underlying. It is based on generally mutual funds, you buy and sell at closing NAV. Tax efficiency is more in ETF because they are more passive. Less in mutual funds because they are active. Tracking error is less in ETF and it is more in mutual funds. Now, taxation of ETFs. Taxations is based on distributions that the fund makes or purchase and sale of ETF. So quickly, when you buy and sell ETF, either you can make a capital gain that you have to pay tax on, 50% of it is taxed, or you make a capital loss. Capital loss can offset capital gains in last 3 years. It can offset capital gains in current year, or you can carry it forward for future offsetting indefinitely. Now, distributions, if it is dividend and interest distribution, it will be taxed accordingly. Interest is taxed according to marginal rate. Dividend is taxed, but you get some dividend tax credit if it is a Canadian company. Capital gain distribution. So there are two important things that you have to remember: capital gain refund mechanism and reinvestment phantom distributions. So it means that capital gain refund mechanism means when you have already paid some tax. So it generally happens when reinvestments is there. So when reinvestments is there, you have already paid some tax on the distributions you have received. So because of that, your adjusted cost basis, your cost basis is adjusted to reflect that. So if you have got $100 of distribution, which is again reinvested, then that $100 increases the adjusted cost basis. So this is covered in both of this: capital gain refund mechanism and reinvestment phantom distributions. Next, there is non-cash distributions, that is return on capital. Generally results because of non-trading activities like renting out shares. It's an example of non-taxable contribution. So rent that you receive, generally you can structure it as ROC, return on capital. So you are not explicitly taxed on it. Okay, so distributions are taxed like this. Dividend and interest. Dividend is taxed, but you get dividend tax credit. Interest is taxed at marginal rate. Capital gains are taxed at 50%, right? But you get refund mechanism as well as reinvestment phantom distributions based on reinvestment. So adjusted cost basis changes, and non-taxable distributions, that is return on capital. Now tips for trading: always use limit orders when you're trading in ETFs. Place large trades, so do not place small trades, because then it gives the designated dealer some space to generate those units. Avoid beginning 15 minutes and end 15 minutes while you're trading, because the volatility of market is extremely high during that time. Avoid trading when underlying securities are closed, because then the price discovery mechanism and arbitrage doesn't work, so the ETFs can deviate in value. Avoid trading when underlying securities trading is halted because of news or certain corporate disclosures. So more complex exchange traded fund roles. So you can have core and satellite portfolio construction. Core means there are certain ETF products that you keep in core, and satellite portfolio means you take advantage of the market by putting some money in other ETF products. ETFs can be used for rebalancing, so it is very easy to do it in ETF. Let's say you want to change your allocation from equity to debt, so you can start buying debt ETFs rather than buying bonds, which is difficult. You can do tactical asset allocation. Moving between funds is much easier. Cash management is much easier in ETFs because they have lesser cash drag. Exposure to one's hard to access market is there, because you have you can buy emerging markets ETF and international ETFs. Also, ETFs can be used for tax loss harvesting, that is selling at a loss at the end of the year to get certain tax breaks. That can be done by ETFs. Other related products in ETFs are mutual funds of ETFs. So these are mutual funds that invest in ETFs. Then there are exchange traded notes. Exchange traded notes are generally guarantees that are given by banks. So these are not generated by the fund houses, these are generated by banks, and bank guarantees to pay you based on the index performance. So you invest $100 with bank, and based on the index performance the bank will pay you interest. So these are called as exchange traded notes. They are quite different than ETFs because they also have counterparty risk. If the bank defaults, then the notes default. Hello everyone. So in the last recording we saw mutual funds and ETFs, exchange traded funds. So we are going into other managed products in this chapter. So chapter 20 is all about other managed products. So in this chapter we are going to discuss different types of segregated funds. What is a segregated fund? Then we are going to discuss hedge funds, labor sponsored venture capital fund, close-ended funds, income trust, and listed private equity. So before we start with segregated funds, just to recap managed products. So all managed products are effectively a pool of capital that is put together by investors. It is given to a fund manager, and fund manager on behalf of every investor makes investments. Whatever return that investments generate, that are transferred to investors. So all managed products are effectively a pool of fund that is managed by a fund manager. Now we have seen mutual funds and exchange traded funds. So both of them do not have any kind of guarantee. So whatever investments you make into a mutual fund or an exchange traded fund, they do not come with any kind of guarantee. So capital you invest is always at risk. Now if you see segregated funds, they are considered to be an insurance product. So they are a combination of insurance and investments. Features that they have maturity protection. So maturity amount is protected, it's guaranteed. Maturity amount is generally a percentage of amount you invest in. So a percentage of amount you invest in is always protected or guaranteed. There are death benefits. So if the person who has bought this segregated fund dies, means person on whose name the segregated fund is dies, then the beneficiaries get certain death benefits. And because it is an insurance product, it has creditor protection. So creditors cannot claim these products. So these products are formed as trust and they do not come. That means what happens is, in an insurance company, when you buy a segregated funds, so your the investments that the fund makes, it is not in your name, it is in the name of insurance company. That's the reason they are not attached if the creditor sues you, and they have creditor protection. So regulations of segregated funds, so they are individual variable insurance contract. So each time you buy a segregated fund, you make a contract with an insurance company. They are regulated by provincial insurance regulator. Now this is a key difference. Mutual funds and ETFs are regulated by provincial securities regulators, and insurance contracts are not regulated by securities because they are not investment products. So segregated funds are regulated by provincial insurance regulator. Canadian Life and Health Insurance Association provides guidelines which are accepted by most of the provinces. So this is an SRO. In case of mutual funds, it is MFDA, Mutual Funds Dealers Association. In terms of segregated funds, it is Canadian Life and Health Insurance Association. Office of the Superintendent of Financial Institutions is responsible to see capital adequacy of insurance company under Federal Insurance Companies Act. Then there is ASURIS. ASURIS is an insurance industry self-financing provider, covers only death benefit and maturity benefit. So what does ASURIS do? ASURIS protects you as a segregated fund buyer in case of there is default from the insurance company. So if insurance company files for bankruptcy and defaults, then you are protected. Protection is 60,000 or 85% of guaranteed amount. Whichever is lower is protected. Structure of segregated fund. So there is a concept of notional unit. So like I said, when you buy a segregated fund, the investment proceeds are always in the name of insurance company. You do not make investments in your own name. So in such a case, the insurance company does not give you actual units, but they give you notional units. Now these notional units are given so that it is easy to track performance of segregated funds. Now different parties that are involved in segregated funds. So there is a contract holder, the person who is responsible for buying the segregated fund. There is an annuitant, the person whose life is insured, and then there is beneficiary, the person who gets benefit out of this fund, who is named as a beneficiary. Now contract holder and annuitant can be same. So I can buy segregated funds in my own name, or I can buy segregated funds in my wife's name. In this case, the contract holder and the annuitant is different. So there should be an insurable interest in case of annuitant and the contract holder. So I cannot buy insurance on some third XYZ person that I don't know and name him as an annuitant, because there won't be any insurable interest. Now features of segregated fund. So there are maturity guarantees. So provincial regulations have that at least 75% of amount invested in a 10+ year period or on death is guaranteed. So provincial regulation says minimum 75% of what you invest in segregated fund, if the maturity is after 10 years or in case of death, is guaranteed. Now most of the segregated funds have much higher guarantee than that. They generally have 100% guarantee. So in a segregated fund, the amount you invest is most of the times guaranteed. Regulations permit that 75% should be guaranteed, but in practice generally 100% is guaranteed. Age restrictions, so no more than 80-year-old. So if you are buying a segregated funds, they are generally not available beyond the age of 80, and as your age progresses, the protection reduces. So there is reduced protection as you age. Now there is a concept of reset date. So if I have 30 years to go for my retirement, and I can buy segregated funds in chunks of 10 years. So every 10 years I can reset my segregated fund. So what happens when you reset? Whatever lock-in value would be there of the fund on reset date, that would be frozen as guaranteed amount. So example, I start a segregated fund with $10,000. After 10 years on maturity, the fair market value of that segregated fund is 20,000, and I put a reset. So what happens? Now the 20,000 becomes the invested amount, and then 20,000 is guaranteed, not the 10,000. So I can lock in my current market value on reset dates. Now in segregated fund, there is concept of death benefit. So death benefit is always guaranteed amount minus fair market value, and death benefit arises in case the guaranteed amount is more than fair market value. If guaranteed amount is less than fair market value, then death benefit is not there. Now what does death benefit means? So in case of death, you are provided with guaranteed amount or the market value of the fund, whichever is higher. So if your market value of the fund is 120,000 and guaranteed amount is 100,000, then you are provided 120,000. In that case, the death benefit from the fund is 0. Okay, but if the market value of the fund is 90,000 and guaranteed amount is 100,000, then you would be provided 100,000, though the funds are only worth 90,000. The difference of 10,000 will be provided as death benefit. So death benefit is always difference between guaranteed amount and fair market value. So in this case, death benefit is 0, 100,000 minus 100,000. In this case, death benefit is 10,000, 100,000 minus 90,000, 10,000. In this case, death benefit is again 0 because fair market value is greater than guaranteed amount. One more significance of death benefit: death benefits are not taxable in Canada. So whatever death benefits you get, they are not taxed, and maturity amount is taxed. Creditor protection. So segregated funds have creditor protection. So under bankruptcy and family law, they are protected. So segregated funds are not attached to your properties in case of bankruptcy or if creditor is putting a lawsuit against you. Now there is a condition that segregated funds should be bought in good faith to qualify for credit protection. Segregated funds should be bought in good faith to qualify for credit protection. Means you cannot buy a segregated fund before 1 year of bankruptcy. So if there is a bankruptcy and segregated funds have been bought 1 year before the purchase, then they will not have any credit protection. They will come under bankruptcy assets. And if you are already legally insolvent, means you are not a legally solvent person and you still buy segregated funds, then they will not have any credit protection. Also important thing, segregated funds bypass probate. So probate is a process whereby you prove or disprove a will in courts. So whatever will is there, you prove or disprove it in court. So segregated funds do not form part of will asset. Also important thing, there is no actual units that are distributed when you buy segregated funds. There are deemed units, or so deemed units, right? So whatever allocations you get, so dividend, capital gain or interest, so it is deemed income, so it is called as deemed allocation. So allocation, it is deemed income. NAV does not fall. So important thing, in both mutual fund and in ETF, whenever distributions are made, NAV generally falls. But in case of segregated funds, NAV does not fall. So fund contract receives additional income. And generally whatever allocations you get, like dividend, capital gains or interest, they increase adjusted cost basis of the fund. Okay. Tax treatments of guarantees, they are taxable as capital gain, and tax treatment of death benefits are tax free. Now comparison between an segregated fund and a mutual fund. So legal status, it is an insurance contract. Mutual fund, it is a securities. Owner of the fund, it's an insurance company. In mutual fund, the fund owns it, so indirectly when you buy it, you own it. Nature of fund units, there is no legal status in segregated fund, and mutual fund, it's a legal property. Regulator, it is provincial insurance regulator. In case of mutual fund, it is provincial securities regulator. Issuer, it is insurance companies that issue segregated fund. In case of mutual fund, it is mutual fund companies. Main disclosure, it is information folder, and in mutual fund, it is fund fact documents. So this is also a big difference. So mutual funds have fund fact documents and segregated funds have insurance folders. Frequency of valuation, segregated funds are valued daily, mutual funds are also valued daily. Redemption, it is upon request. Mutual fund, it is upon request. Required financial statements, so segregated funds need audited annual statements. Mutual funds have audited annual and unaudited semi-annual. Seller's qualification, you need to be a licensed insurance agent, plus you need courses like CSC. In mutual fund, you need to be a licensed mutual fund rep. Guaranteed amount, yes, it is there in segregated funds, it is not there in mutual funds. Protection against issuer insolvency, it is provided by Assuris. Means if the insurance company defaults, your amount, means some amount is provided by, some kind of insurance is provided by Assuris. In case of mutual fund, it is provided by MFDA, Investor Protection Corporation. Then there are death benefits in segregated funds. There are no death benefits in mutual fund. Credit protection is there in segregated funds. Credit protection is not there in mutual fund. It bypass probates. It doesn't bypass probate. Next is hedge funds. Now only thing you have to remember is hedge funds are similar to mutual funds. So there is a pool of money, there is a fund manager, and fund manager makes investment decisions. But important thing, they are not constrained by rules. So they have very less regulations. For example, if you invest in a mutual fund, mutual funds have lot of investment restrictions. A mutual fund cannot buy more than 10% of a stock in a company. So it cannot have concentrated positions. It cannot buy more than 10% voting rights. It cannot short sell. It cannot use leverage. It cannot use derivatives beyond permittable use. It cannot invest in commodities. It cannot take exposure to currencies. So there are a lot of restrictions that are put on mutual funds. Hedge funds do not have such restrictions. So they can take concentrated positions. They can invest more than 10% in one company. They can have more than 10% voting rights in one company. So They can invest in, they can short sell, they can use leverage, they can invest in currencies, so they can take exposure in commodities. So they are not constrained by rules. So mutual funds, you are allowed to take short positions, leverage, you can use derivatives beyond permissible use. So all these things are possible in hedge funds. Investing in hedge funds, so sales is allowed without prospectus for exempted investors. So if you're selling, okay, before going into that, you're not allowed to sell hedge funds to retail clients. The investor whom you're selling hedge fund as an advisor needs to be a sophisticated or an accredited investor. So if you're selling hedge funds to an accredited or a sophisticated investor, you do not need prospectus. Now what is an accredited investor? In Canada it is 1 million in assets, 1 million in net assets, or 200,000 of annual income, and 300,000 if it is joint account including spouse. Minimum investment exemption is there under National Instrument 45-106. That is, even if the investor doesn't qualify as an accredited investor, but he is putting 150,000 straight investment into a hedge fund, he can still invest. Then hedge funds do not offer prospectus. They are exempt from even offering. They generally offer memorandum. So hedge funds are sold by offering memorandums. They are not sold by offering prospectus. Benefits and risk by investing in hedge funds. Benefit: the correlation with traditional assets is very low. So hedge funds have very low correlations with traditional assets. And other biggest benefit that hedge funds have is absolute returns. So mutual funds will always have some kind of relative return. So mutual fund will always be judged against some benchmark. So that is their objective. Hedge funds generally have absolute return objective. So irrespective of what benchmark does or irrespective of what market does, hedge fund will have objective of getting, let's say, 4% return per year, right? Minimum. So irrespective of market going up, down or sideways, hedge fund has to attain that objective. So objectives of hedge fund is absolute returns irrespective of market conditions. Risk: their regulation is lighter regulatory oversight. There is manager and market risk. So hedge fund investments are heavily dependent on managers. So if manager quits, then it becomes very difficult to replace him and the performance may fall. Also there is market risk. So even though they have absolute return objectives, there is still market risk there. The investment strategies are quite complex, so they involve complex investment strategies. There are liquidity constraints, so they are not as liquid as mutual funds. There are lock-in periods when you invest in hedge funds, so there are liquidity constraints. Then there is business risk. Business risk means most of the mutual funds are big companies. Hedge funds, if you see, many of them are startups. So there is higher risk of failure in case of startups. So there is additional business risk when you invest in hedge funds. Now, a key component of hedge fund is incentive fees. What is incentive fees? Along with performance, along with management expense ratio, MERs, and along with commissions, you also have to give incentives to fund managers of hedge funds. Now incentives are dependent on performance of hedge fund. So in a mutual fund, you do not, means a fund manager is not awarded if the mutual fund performs really well, because mutual funds have commission structures for sales agents and have MERs, that is management expense ratio or fund management fees for fund managers. But in case of hedge funds, they have additional incentives if hedge fund performs really well. So there is incentive fees based on performance in case of hedge funds, which is not there in case of mutual funds. Now for incentive fees, there is a concept of high watermark and there is concept of hurdle rate. So what I'll do is I'll go to Excel and try to explain it to you. So what is high water mark? So let's say the fund was invested for 5 years and it started with 400 million, it went to 420 million, then it dropped to 380 million, and it went back to 420, and finally the performance was it went to 475 million. So this was the fund performance of hedge fund. It started with 400 million, then it went to 420, then it went down to 380, then it came to 420, and then it came to 475. So what is high water mark? In case of high water mark, if you are considering performance of a particular year, highest value before that, highest fund value before that will be the watermark. So let's say you're considering performance of the hedge fund in second year. You're calculating incentive fees for performance of the hedge fund in second year. So whatever value the fund has before this second year will be the high watermark. So in case of second year, high watermark will be 400 million because that was the value previous to that year of the fund, highest value. Now in case of third year, the watermark will be 420 because if you are calculating fund performance in third year, then the watermark is previous highest value of the fund, so that is 420. The watermark in third year will be 420. Watermark in fourth year will also be 420 because previous highest value is still 420. So if you are calculating incentive fees, it will be still 420, and watermark in fifth year will still be 420 because that is the highest value before this. So what is a high watermark? High watermark means if you are looking at a performance of a hedge fund in particular year, highest value of that hedge fund before that year will be watermark. Now what does high watermark means? That if the fund beats the previous highest value, only then it will be paid incentive fees. For example, will incentive fees be paid in second year? Yes, because the watermark was 400 million and the value is 420, so it is above higher watermark, so incentive fees will be paid in second year. Third year it went down to 380, so will incentive fees be paid? No, because watermark is 420 and the current fund value is 380, so incentive fees will not be paid. In fourth year it is 420, so fund value went up from 380 to 420, so fund did grow in size, but it is still not beating the watermark of 420, so incentive fees will not be paid. In fifth year incentive fees will be paid because watermark is 420 and the fund value is 475. So this is how a high watermark is used. Next concept is hurdle rate. Hurdle rate means it is the minimum rate beyond which incentives are paid. For example, if a fund gives 10% rate of return, it fund grows 10% and the hurdle rate is 5%, so incentives will be paid on whatever performance is there above the hurdle rate. But if fund performed 3%, if fund grew 3% and the hurdle rate is 5%, there will be no incentives. If it is 10%, there will be incentives. Okay, so hurdle rate is the minimum rate you have to achieve as a fund manager to get incentives, and high watermark means it is the previous high of fund value that you have to beat to get incentives. Okay. Now this is an interesting question. How much must a fund earn if the high watermark is 10% above the current value and hurdle rate is 3%? So fund must earn 10% plus 3%, 13% before it gets any incentives. Tax implications of hedge funds, it's quite complex because it depends where the funds invest in. But certain hedge funds use tax deferrals, so they invest in offshore investments and they use tax deferrals, so you don't have to pay tax unless and until you bring money back into Canada. So they use that structure. There is short selling and leverage in hedge funds. Now hedge fund strategies can be relative value strategy. In relative value strategy, you arbitrage. So you buy an asset in one market and you sell it in another, and it is exactly same. So long and short is exactly same. So it is generally called as a risk-free strategy, and the market risk or beta of this risk is almost zero. So this works in upward markets, sideways markets, as well as downward market. So relative value strategy means arbitrage, buying in one market, selling in another, buying one asset, selling other asset. Okay. Event driven strategies is generally done on particular events like mergers and acquisition. For example, if an acquisition is happening, so A company is buying B company. So as a hedge fund manager, you will buy the target shares, B company shares, because generally after mergers, the target shares appreciate. So it is based on mergers and acquisitions or any other corporate actions. Directional strategies is where you go long and short simultaneously, but long and short are not of exact same dollar amount or exact same value. For example, if you're going $100 long and $50 short, then it is a directional strategy because long is more than short. Same way, if you're going $100 short and $50 long, then it is still a directional strategy because short is more than long now. Now in case of directional strategy, I'll again go to Excel because there is a concept of hedged portion and unhedged portion. For example, if you're putting $100, if this is your trade, you're going $100 long and you're going $60 short. So you're going more long than you're going short. So what will be unhedged portion? Unhedged portion is always difference between the two. Whatever is long, bigger, long or short, minus whatever is shorter, whatever is small. So difference between the two is unhedged portion. Hedged portion is this lesser amount between long and short. So hedged portion is 60, that doesn't have any market risk, and unhedged portion is 40, that does have market risk. Now if this is the case, you're going $100 short and you're covering it up with $80 long. So this is your trade. So it is still a directional trade because long and short are not same. If they are same, then it is a relative value trade. Now what will you do? Unhedged portion will be difference 100 minus 80, and hedged portions will be the lower amount between 100 and 80, that is 80. Okay. So there are three strategies: relative value strategy, So long and short, or buying in one market, selling in another. So it is called as arbitrage, but they are of the same value. Market risk is relatively low. Event driven strategies done on specific events like mergers, acquisitions, etc. Market risk is medium. It does have exposure to market. Directional strategies have exposure to market, and it is going long and going short on the same stock, means on similar stocks, but not of the exact same amount. Now, funds of funds. So these are mutual funds that invest in hedge funds. Minimum amount to invest is generally around 25,000. There can be a single strategy multi-manager fund. So such type of hedge funds invest in the same strategy. For example, if they only invest in relative value hedge funds, but they invest in multi-managers, so they invest in different hedge funds. Or there can be a multi-strategy multi-manager fund that invests in different strategies and then different managers within those strategies. Now, what are funds of hedge funds? These are mutual funds that invest in hedge funds. So they reduce the risk that you are exposed to as a hedge fund investor to a single manager. Advantage of investing in funds of hedge funds. So there is proper due diligence. It is difficult for a single person to do due diligence on hedge funds because there are less regulations and they are not very transparent. So risk of due diligence is quite low if a mutual fund if a fund manager who is qualified does it for you. Reduced volatility. They are less volatile than individual hedge funds. There is professional management. They have access to hedge funds. Now, like I have said, hedge funds are generally small startups, so it is sometimes difficult to get access to those hedge funds. So they have better access. Ability to diversify with smaller amount. By smaller amount, you can invest in 10 different hedge funds or 20 different hedge funds. And there is manager and business risk control. Disadvantage, there is additional cost. Still, there is no guarantee of positive returns. There is low or no strategy diversification. If you're investing in a single strategy multi-manager fund of fund, then there is no diversification of strategy. There can be insufficient or excessive diversification. So you can have a fund of fund only having 10 hedge funds, or you can have a fund of fund having 1000 hedge funds. So in case of that, there is excessive diversification. And they can have additional source of leverage. So they can borrow money and then invest in hedge funds. So that creates additional leverage. So difference between a mutual fund and a hedge fund. So mutual fund short position is limited. There is limited use of short positions in close-ended funds, and generally they cannot use short sell. Hedge funds can do short selling. Use of derivatives is limited up to 10% of fund value. Hedge funds, they can use derivatives. Liquidity is high in case of mutual funds. Liquidity is quite restricted, so they have low liquidity in case of hedge funds. Sales method, they are sold with fund facts to general public. Hedge funds are sold with memorandums to sophisticated investors. So this is a big difference. They use fund fact document, they use memorandum, they are sold to general public, they are sold to sophisticated investor. Regulatory oversight is more in mutual fund, it is less in hedge funds. Fees, you have management fees in mutual fund, you have management as well as performance fees in hedge fund. Return objectives are relative in case of mutual funds, they are absolute in case of hedge funds. Valuation, mutual funds have daily valuation, hedge funds have monthly valuation. Disclosure, mutual funds generally have quarterly or annual disclosure. Hedge funds disclose their holdings annually, so they disclose to public annually. Position concentration is not allowed in mutual fund, it is allowed in hedge funds. Next is labor sponsored venture capital corporations. So these are structured to provide capitals for small to mid-size and emerging companies, and these are structured by labor organizations as well as labor unions of provinces. Advantages is if you invest in labor sponsored venture capital corporation, you get a federal tax credit of 15%. Along with that, most of the provinces you also get provincial tax credit. I'm in Alberta, so it is not there in Alberta as well as it is not there in Ontario. Disadvantage, these are high risk and these are speculative investments because they invest in small and mid-sized companies. There is redemption restrictions, so if you redeem before 8 years, you have to pay back that tax credit. So that tax credit there is a clawback on that tax credit if you sell it before 8 years, and they have higher cost. Next is close-ended mutual funds. So these are midway between open-ended mutual funds and ETF. So close-ended mutual fund works. You give money to a fund manager. Fund manager issues you units. Those units are listed on stock exchange. So it provides liquidity by listing its units on stock exchange. Difference between an ETF and an close-ended mutual funds. ETF, like we saw in last class, they have in-kind, redemption and creation process. Close-ended mutual funds do not have in-kind, creation and redemption process. Advantage, they have lower management fees than an open-ended mutual fund. Important fact, they mostly trade at a discount to NAV. Even though they're listed, their units are listed on exchanges, they trade at a discount to NAV, and this discount generally increases in a bear market. Ability to buy back, so there can be an interval or a close-ended discretionary fund which has certain buyback provisions into it, because generally close-ended funds do not have buyback provisions. So when they get money from investors and they issue units, that's it. Investors cannot go back to fund and ask for money. But certain close-ended funds can have buyback mechanism. Then if they have buyback, then they are called as interval or close-ended discretionary funds. Advantages, so they have advantage of diversification. Short selling is allowed in close-ended mutual fund. They have less cash drag, so most of the funds that the close-ended mutual fund gets, they are invested, so they have less cash drag. They have long-term outlook, and capital gain and dividend are directly paid to investors. There is no reinvestment, so adjusted cost basis is easy to calculate. Disadvantage, bear market, as I have discussed, they generally trade at a discount to their NAV when they trade on exchange, but this discount generally amplifies when there is bear market. They are less liquid. There is no reinvestment risk, so reinvestment risk is low. So no schedule for declining deferred sales fees, so they are less liquid. Even though they are traded on stock exchanges, the liquidity is quite low. Reinvestment of dividends or capital gains doesn't happen, so it is directly paid into your account. Then generally mutual funds have declining sales commission or declining back end loads. When you sell the mutual fund, you have to, in certain cases you have to pay certain commissions, and they go down as the time period of holding increases. But in case of close-ended mutual funds, it is fixed, so there is no schedule for declining sales deferral fees. If traded on foreign exchange, they are considered to have foreign income. Next is income trust. Income trust is like mutual funds, so they pool money and then they invest, but investments are not done in stocks and bonds. They are done in either real estates, either conventional real estate like commercial or residential real estate properties, or it is done in assets of business, not stocks and bonds of a business, directly asset of a business. So REITs is real estate investment trust. So these are mutual funds that invest in actual real estate, so they buy commercial and residential properties. They are good hedge against inflation because of real estate investments. They have better liquidity than the real estate properties because they are traded on exchange, and they have professional management. Business trust is similar to REITs, but instead of buying actual real estate, they buy business assets. So they may buy a restaurant, they may buy some supply chain, or they may buy cars, etc. And whatever income they generate from that asset, they keep. Taxation, generally income trusts are taxed like Canadian companies, so they have to pay tax, but there is a pass-through status for REITs if they distribute income. So in case of REITs, if they are distributing income, then they have a pass-through status. So there is no taxation that REIT has to pay, but whatever distributions the investor gets, they are taxed in investor's hand. Next is listed private equity. So private equity generally invest in unlisted companies. Listed private equity means this private equity is then traded on stock exchange, so it has little bit of more liquidity. Strategies that listed private equity invest in: leverage buyout, so taking on loans and buying a company, or combination of loan and equity to buy a company. Growth capital, providing capital for growing companies. Turnaround, investing in out of favor industries and hoping for a turnaround, means investing in out of favor distressed stocks and hoping for a turnaround. Early stage venture capital, investing in companies that have yet to prove that idea. Late stage venture capital, investing in companies that have little bit track record but they are still not profitable. Distressed debt, buying debt of government or of companies that is currently under stress. Advantages, it is you can get access to legitimate insider information. Private equity can have concentrated positions, and private equity, difference between a private equity firm and a mutual fund is, mutual funds does not take part in day-to-day, means in strategic decisions of the company that they invest in, but private equity players, they take part in running the business, so they have access to insider information and that is legitimate. They can have influence over management and flexibility of implementation, so they get all business plans from management, they can discuss with management, so all such flexibility is there. Disadvantage, though they are traded on stock exchange, some of them, but they are still illiquid, and there is dependence on key personnel, so they have manager risk. If the manager leaves, then the strategy goes along with him. So that is it. In chapter 20 we'll discuss more about other managed products in 21. Is lower, so in this case lower percentage is 40, so you're going to get 40 of 10,000, so you're going to make 10 plus the interest, 14,000 is the maturity amount. Third example that they can ask you is, your PPN is based on 3 stocks, average, so average performance of 3 stocks. You have invested $10,000 and the stock values when you invested, so beginning value of the period was, let's say, $100, $120 and $80, and when it matured the value was 120, then 165, and this went to 200. Now this PPN comes with a performance cap of 50% for each stock, so they are not restricting your average, they are having a performance cap of 50% for each stock. So how will it work? This divided by this -1. So I'm calculating returns. So returns are 20%, 38% and 50. 20% is okay because it is below the cap. 38% is okay because it is below the cap. 50%, stock C has generated 50%, but you have to cap it at, stock C has generated 150%, but you have to cap it at 50%. So what will be average? So I'm just copying this here so that I can take an average. Average of 3. So your returns from this PPF will be 36%. If otherwise, if there was no cap, your return would have been 69%. But you don't get 69, you get 36 because each stock had a cap of 50. So effectively, these are the 3 types of questions that they can ask you in the exam. Now, risk associated with PPN. So there can be different types of risk. So there is liquidity risk. That is, the PPN doesn't have, they do trade in secondary market, but sometimes they may not be liquid. There can be performance risk. So index, you don't get 100% of what the index has performed. You get only a part of it. There can be a credit risk. The bank who is generating PPN may default. There can be currency risk if they invest in some foreign index, and there is no predictable return because returns are based on something that is fluctuating. Now this is important for exam. PPNs that are held till maturity. So PPN has a good secondary market, so they can be sold in the secondary market. So you can buy a PPN, and if the index goes up, the value of PPN also goes up, and if you can find a seller in the secondary market, you can sell it before maturity. So if PPNs are held till maturity, the entire income that they generate, it is treated as interest income. Interest income in Canada is taxed 100%. Now if PPNs are sold before maturity, then the income that they generate is treated as capital gain. So it is sometimes far better to sell PPN or before maturity than keep it till maturity, because capital gains have a 50% deduction in Canada. So only 50% of capital gains are taxed. So it is sometimes better to have PPNs till maturity. Interest has 100% taxation, no deduction. So that is there. For exam, you have to be extremely careful. PPM till maturity will be taxed as interest. PPM sold before maturity will have capital gain. Next is a similar product to PPN, so everything is same. There are few differences, we'll go through it. So market linked guaranteed investment certificate. So PPN is a product that is generated by a bank. Market linked GIC is also a product that is generated by bank. So both of them are banking product. Difference, they are non-redeemable till maturity. So PPN does have a secondary market, and if you can find a seller, you can sell it. But a market linked GIC is not redeemable until maturity. There is maximum cap or participation rate. So you can, same thing like a PPN, you can only participate to a certain extent in maximum cap, or you will get some X percentage of index performance, not the entire thing. Exactly same as PPN. So sometimes in the exam, they ask you the questions that I did on Excel, they will replace PPN with a GIC. Same thing. So GIC also works in a similar way as PPN. Key difference. PPN that we saw was not insured by CDIC. Market linked GICs are insured by CDIC. Some GIC returns are based on level on index on a particular date. Some are based on average returns. So this is something that you have to remember. Sometimes they track performance of index over certain dates, particular dates. So 1st of Jan this year versus 1st of Jan 5 years from now. This is an example of a GIC or a PPN that tracks index on a particular date. Some of them calculate average years per year, average returns per year, and then they project it. So let's say a 5-year GIC that focuses on average return of an index. So they will calculate average returns for each of those years. So return is first year is 20, 30, 40, and let's say -10. So they will average it out. That is your return. So for me, average returns are much safer than particular date tracking, because a particular date can have a big fall all of a sudden just before maturity. Some allow investors to lock in some for redemption on a specific date. So some GICs have a provision that you can redeem them on yearly anniversaries. So that's what happens in a practical way. A risk is major risk in normal GICs that don't have early redemption. The risk is non-redemption, so your money is locked in. Important fact, there is no secondary market, so they are always taxed entirely. So all gains from market linked GIC will be taxed as interest income. Now this is super exciting. This is the most amazing product that they have in syllabus. So this is called as a split share. So things to remember: split share is dividing what you get from a stock. So from a stock you get dividend and you get capital gains or loss. So what does a split share do? It divides these things. So a particular investor will only get dividend, only get access to dividend, and a particular investor will only get access to capital gain and loss. So this is how a split share is constructed. So we'll go step by step. So they are creating a split share on stock of RBC. Value of that stock is $100 and an average dividend is around $3 for $100 investment. So it has a 3% yield. So how will it work? So generally a split share corporation will buy shares of RBC. Then they will structure a close-ended mutual fund. So they will create a close-ended mutual fund out of these RBC shares. Now that close-ended mutual fund will create preference shares unit and capital share units. Preference share unit, the person who buys preference share unit will have to pay $50, but he gets access to all dividends. The person who buys capital share unit will also pay $50, but he gets access to all capital gains and losses. And they are structured as a close-ended mutual fund with pass-through status. So I'll go to an Excel and explain it to you how it works. Oh, that is too much zooming. Yeah, this is a little bit less. Okay, so let's continue with that example. RBC was available at 100. So you are creating two split shares out of it. So RBC preferred and RBC capital. Okay, so you are selling this as $50 and this also at $50. Now I am giving you situations of how it will work. In the first case, in 2019, RBC provided a dividend of $3. The original RBC stock gave a dividend of $3, and at the year end the stock was trading at 140. How will it work? This entire $3 dividend goes to preferred stockholder. So I am adding few things. So dividend, entire dividend goes to preferred stockholder of RBC. Capital gain, stock doesn't get anything, but capital gain that the stock generated, so it went from 100 to 140, so it generated a capital gain of 40. So this capital gain goes to capital share. So if you calculate percentage returns, so this guy makes $3 on $50 investment, so he makes a 6% dividend gain as compared to 3% given by the original stock. And this guy makes $40 gain on a $50 investment, so he makes 80% return, and the original stock was going up 40%. So there are leveraged gains in dividends also and in capital stock also. So you get more dividend if you invest in a preferred stock, and you get entire capital gains that are more than the original stock if you invest in a capital stock. So this was when stock went up. What happens when stock goes down? So let's say instead of 140, it went to $80. So what happens when this stock goes to 80, right? So in this case, there is a capital loss. So from 100, it went to 80. So $20 is the capital loss, right? Now this capital loss is not shared with preferred holder. So value of preferred stock still stays at 50. But this capital loss is transferred to the capital holder. So RBC capital stock will get this $20 loss. So effectively what is happening, in a split share, all dividends goes to a preferred stockholder and all capital gains and losses go to the capital stockholder. And they generally, this is what happens in real industry, they generally guarantee this $50 investment in preferred stock. So whatever you invest in a preferred stock, that is guaranteed by the split share company. How? Because all the capital loss that they make, they transfer it to capital stock. So you don't get any loss. So you just keep on getting dividends. But if dividend is not paid, then it becomes a problem. Okay. So this capital that you invest in preferred stock is generally guaranteed, because if it goes below and means the loss is around $50 and you have 100% loss, they will close this close-ended mutual fund and return back your $50. So there is very low possibility of loss of capital if you invest in RBC preferred stock. Okay. So once again, split share, preferred stockholders get all dividends, get no capital gains. Capital shareholders get all stocks and don't get any dividend. Capital share, it is ranked after preferred stock in case of wound up. So first preferred stockholders are paid, and if anything is left, capital stockholders are paid. They are not paid unless preferred holders are paid. Risk is they have leveraged returns. So we have seen for a 40% gain you are making 80% gain, but for a 20% loss you are losing 40%. So loss is amplified as well as return is also amplified. Volatility, so it has been proven by Scotia Capital that capital stocks or capital shares are more volatile than original stocks, and there is loss in value if there are dividend cuts, because if dividends are cut, then generally when you invest in a preferred stock in a split share corp, the dividends are guaranteed. So 3% dividend is guaranteed. So if the company is not paying dividend, then the company will have to sell some stock and pay preferred stock dividends. In that case, there is loss of value to capital shares. Preferred share investment, they have reinvestment risk. So they are paid money, so you have to again reinvest, and also if the corporation is ended prematurely, you get your money back, but you have to find an investment vehicle. They have a risk of early redemption, so they can be redeemed early. They have credit risk, so the corporation that is starting the split share may default. They can have decline in value of portfolio. So if there are no dividends paid, then stock has to be sold, and then there is decline in value. There is taxation risk. Currently in Canada, dividends have a preferential tax treatment, but that can change anytime. Then there are dividend cuts that also creates possibility of loss. Next is asset-backed securities. So what is an asset-backed securities? So I'll brief you about basics, then we'll go through this. So traditionally, if you see, for a bank, the loan that it gives is asset and deposit it takes is liability. So if you see a bank's balance sheet, assets that you see for a bank, those are loans that are given, and deposit that it takes are liabilities that it has. Now there are different norms that banks have to follow. One of the norms is risk weighted capital. So whatever asset it has to raise equivalent amount of capital, certain percentage of that as capital. So more loan it gives out, more capital is required to be raised. So it becomes difficult to banks to have those large loans on their balance sheet. So what do banks ideally want? Banks ideally want to remove those loans from balance sheet and sell it out to some other entity. So asset-backed securities gives banks a way to remove those assets, remove those loans from its balance sheet and give it out to some entity, which then sells it to investors. This entire process is called as securitization. So what happens in a securitization process? The asset originator, that is a bank, creates a reference portfolio, so creates a group of loans. Then they sell these loans to an SPV against cash. So they sell that loans, get cash for it. This SPV, that is a special purpose vehicle that is created by bank, then sells it to an investor. So how do they sell it? From this loan portfolio, they create 3 tranches. Okay, and then they sell those tranches as units to investors. Investors buy those tranches by paying cash. Cash goes to issuer and cash goes to the bank. So what is happening? Bank is selling the loans, investors are buying those loans from SPV. Whenever loans, the original loans are paid, that is people who have taken those loans pay their principal payment or pay their interest payment, those payments are transferred to SPV, which then transfers it to investors. Now what does SPV do? SPV don't sell those loans as it is to investors. What they create is something called as a tranche. So there are 3 types of tranche: a senior tranche, a mezzanine tranche, and a junior tranche. What are these tranches? These are priorities of payment. So whenever the original loan is paid, the group of loan gets payments, first payment happens to this senior tranche. So investors who are buying senior tranches get the highest priority of payment. Then mezzanine tranche is paid, and then finally junior tranche is paid. Now senior tranches are least risky because they have priority of payments from asset originator. Then mezzanine tranche is risky, then the junior tranche is risky. So risk wise, senior tranche is the safest, junior tranche is the riskiest. Now to compensate that, junior tranche is generally paid a higher interest rate, senior tranche receives a lower interest rate. So in the exam they can ask you, as an investor, mortgage-backed securities and ABS, asset-backed securities, work in the same way. So mortgage-backed securities will also have a group of loan, majorly housing loans. Asset-backed securities have loans apart from housing loans that they sell, but the structure is same. So in the exam they can ask you, if a conservative investor is there, which type of tranche would he prefer? He would prefer a senior tranche because the risk is low and they have priority of payments. Then a aggressive investor who wants high returns may go for a junior tranche, right? Now risk in an asset-backed security, major risk is prepayment risk. What is prepayment? Anyone who has the original loan can prepay that loan. Now if the person prepays that loan, that money will flow to an SPV and the money will flow to an investor. But that loan is getting cancelled because prepayment means you're cancelling that loan, some part or whole, right? So when the loan gets cancelled, there won't be any future interest payments. So though the investor is getting money because the loan is prepaid right now, but all the future interest payments on that loan is nullified. That is why the biggest risk that the investor face in an asset backed or a mortgage backed security, it is prepayment risk. So once again, asset backed securities is a way of selling loans to an investor, and it is a way for investors to getting access to banking loans or getting exposure to banking loans. What happens? An asset originator creates a portfolio out of banking loans. They sell it to a special purpose vehicle who is an issuer, who then creates tranches from those loans. Senior tranche who has the highest priority, lowest risk, mezzanine tranche and junior tranche, and then sell these tranches to investors. Investors who buy ABS get access to principal and interest payment that the original loans pay. One more type of an ABS is asset-backed commercial papers. So they are exactly the same. Only difference is Asset-backed securities are generally made from long-term loans. Asset-backed commercial papers are made for short-term loans. So these things, they generally minimize rollover risk and they match short-lived assets with short-term fundings for companies. Now this is important. Mortgage-backed securities are made in the same way as an asset back. So same thing. So a bank has loans, sell it to SPV and sells it to investor. When the loans are paid principal and interest, the investor gets interest and principal. The difference is the loans that a mortgage-backed security has are housing loans. Okay, so MBS has housing loans. So that's the difference. So MBS have interest rate risk. So when interest rate changes, the length of mortgage changes. So that may induce some risk into it. Also, when interest rate change, the prepayment happens. So whenever interest rates are low, there is a higher possibility of prepayment. Then there is credit risk and there is inverse relationship to interest rate. So when interest rates are high, MBS fall in value. When interest rates go down, MBS go up in value. They are extremely safe. So mortgage-backed securities are rated AAA plus in AAA in Canada. So they have very high credit quality. Their credit quality or risk is similar to a treasury bill, but returns are quite high as compared to a treasury bill. They are insured by CMHC. So original mortgages in terms of principal, interest and periodic payments, they are registered by CMHC, and CMHC does not have a cap on amount of mortgage it will insure, so they don't suffer from caps. There can be an open MBS that is created from loans that can be prepaid, so loans that have a prepayment option, or there can be a closed MBS in which only loans that do not have any prepayment option on them are included. So closed MBS are much safer than an open MBS because closed MBS have lower prepayment risk or no prepayment risk. The risk of MBS is compared to a T-bill, but their returns are quite high, so they generally enjoy a yield premium. Benefit of MBS, they have CMHC guarantee, so principal, interest and timing is secured. CMHC does not limit holding size. They have, so CMHC will insure some house that is worth 200 million. It will also insure a house that is $200,000. They have guaranteed monthly payments. Their yield is higher than government bonds, but the risk is similar to a treasury bill. So they have a yield premium. They are liquid because they are traded in secondary market. They have low minimum investment of $5,000 and they are eligible to be held in registered account. Risk that they face, there is prepayment and reinvestment risk. So prepayment of loans can happen. When prepayment happens, you get lump sum money that needs to be reinvested. In case of default, principal is paid, so it reduces future interest. Property damage may happen that may lead to liquidation of that loan. Though they are liquid, they may have some capital loss when they are sold. So this was all about this chapter. One point I will make. So what does the bank get out of doing this MBS? So their loans are off their balance sheet, plus they get additional money to give out for their loans. One more thing is they charge investors for servicing that loan. So they also get payment for servicing the loans that the investors have bought. So we'll go back to this slide, repeat it once and close it. So we have discussed PPN. So it's a product, it's a banking product that invests in index mutual funds where the capital is guaranteed. Market linked is also a banking product that invests in index or an ETF or any underlying in which the capital is again guaranteed. Split share, there is a separate claim on dividends and capital gain. MBS, they create a pool of mortgages and you have a claim on those mortgages, but the loans are housing loans. And asset-backed securities, it creates a pool of loans, but the loans are different, so they can be in home equity, student, auto or credit card. So that's it in this chapter. Thank you for listening.